finance. It's a term that encompasses a vast array of activities and concepts, and all of which are crucial to the functioning of our modern world. It's the lifeblood of any economy, the engine that drives growth, innovation, and prosperity. Without finance, businesses wouldn't be able to expand, governments couldn't fund public services, and individuals would struggle to achieve their personal goals. Imagine a world without money flowing, without investments growing, without the ability to borrow or lend. It would be a world where dreams are stifled, where opportunities are missed, and where progress grinds to a halt. It would be a stagnant world, devoid of the dynamism that characterizes a healthy economy. The absence of financial activity would lead to a lack of innovation, a decline in living standards, and a general sense of economic malaise. In this exploration, we will journey through the cosmos of finance, understanding its key components and their intricate relationships. We'll look at how finance impacts every aspect of our lives, from the food we eat to the homes we live in, and even the technology we use daily. Our focus will be on the United States, a nation with a particularly fascinating and influential financial system. The US financial system is a complex web of institutions, markets, and instruments that work together to allocate resources efficiently and promote economic stability. We'll unravel the mysteries of Wall Street and beyond, delving into concepts like saving, investment, and the role of government. We'll explore how financial markets operate, how they are regulated, and how they influence the broader economy. Fasten your seatbelts, for we're about to embark on an exciting adventure into the heart of the financial universe. This journey will not only enhance your understanding of finance, but also empower you to make more informed financial decisions in your own life. The US financial system is a complex ecosystem. It's a network of institutions, markets, and instruments. All these parts work together to channel funds from those who have saved to those who want to invest. Think of it as a giant circulatory system for money. Our journey begins with financial institutions. These are the key players in this intricate network. Think of them as the organs in our financial body. Banks, stock markets, bond markets, and mutual funds are all examples of these vital institutions. Each plays a unique role in facilitating the flow of funds. Stock markets are like bustling marketplaces filled with energy and constant activity. Here, buyers and sellers converge to trade ownership in companies, creating a dynamic environment where fortunes can be made or lost. These ownership slices are called stocks, representing a fraction of a company's value. When you buy a stock, you become a part owner of that company, gaining a stake in its future. You share in its profits, but also shoulder its risks, as the company's performance directly impacts your investment. The price of a stock fluctuates based on supply and demand, influenced by various factors such as company performance, market trends, and economic conditions. If more people want to buy a stock than sell it, its price goes up, reflecting increased demand and investor confidence. The reverse is also true. If more people want to sell a stock than buy it, its price falls, indicating decreased demand and potential concerns about the company's future. Stock markets provide a platform for companies to raise capital by issuing new shares, which can be used for expansion, research, and development. They also allow investors to buy and sell existing shares, providing opportunities for profit and portfolio diversification. This creates liquidity and facilitates investment, making it easier for investors to enter and exit positions, and for companies to access the funds they need to grow. Understanding how stock markets work is crucial for anyone looking to invest, as it helps in making informed decisions and managing risks effectively. Education and research are key components in navigating the complexities of the stock market, ensuring that investors are well prepared to handle the ups and downs of the market. With the right knowledge and strategy, the stock market can be a powerful tool for building wealth and achieving financial goals. Bond markets are another crucial component of the financial system. In these markets, governments and corporations issue bonds to raise money. A bond is essentially a loan. When you buy a bond, you're lending money to the issuer. In return, the issuer promises to pay you back the principal amount. They also give you periodic interest payments. Bonds are considered less risky than stocks. This is because bondholders have a legal claim on the issuer's assets. Bond prices are influenced by factors such as interest rates, inflation, and the creditworthiness of the issuer. Section 5. The role of banks in the financial system. Banks are the familiar faces of finance. They act as intermediaries between savers and borrowers. When you deposit money in a bank, you're essentially lending it to the bank. The bank, in turn, lends this money to businesses and individuals who need it. Banks play a crucial role in the economy. They provide loans that fuel business expansion, home ownership, and consumer spending. They also offer a variety of other financial services. These include checking accounts, savings accounts, and credit cards. Section 6. Mutual funds pooling resources for investment. Mutual funds allow investors to pool their money together. This money is then invested in a diversified portfolio of assets. These assets can include stocks, bonds, and other securities. Mutual funds are managed by professional fund managers. They strive to achieve the fund's investment objectives. Investing in mutual funds offers several advantages. These include diversification, professional management, and affordability. Mutual funds make it easier for individual investors to access a wide range of investment opportunities. They can do this with relatively small amounts of money. Section 7. National saving, a nation's piggy bank. National saving is a measure of a nation's wealth accumulation. It represents the total amount of money saved by households, businesses, and the government. National saving is the sum of private saving and public saving. Private saving is the portion of income that households and businesses save after spending and paying taxes. Public saving is the difference between government revenue and government spending. When the government spends more than it takes in, it runs a budget deficit. This reduces national saving. Section 8. The dance of saving and investment. In a closed economy, one with no international trade, national saving equals investment. This is because the funds available for investment come from the pool of national saving. When a household saves $1, that dollar becomes available for businesses to borrow and invest. Investment refers to spending on capital goods. These are goods used to produce other goods and services. Examples include factories, machinery, and equipment. Investment is crucial for economic growth. This is because it increases the economy's productive capacity. To Section 9, Balancing Act, Supply and Demand in the Loanable Funds Market. In this section, we will explore the intricate dynamics that govern the loanable funds market, a crucial component of the broader financial system. The loanable funds market is where savers and borrowers interact. This market plays a pivotal role in the economy by facilitating the flow of funds from those who have excess savings to those who need capital for various purposes. The supply of loanable funds comes from national saving. This includes savings from households, businesses, and the government. When people save more, they provide more funds that can be loaned out. The demand for loanable funds comes from businesses and households that want to borrow money to invest. Businesses may need loans to expand operations, purchase new equipment, or invest in research and development. Households might borrow to buy homes, cars, or finance education. The interest rate is the price of loanable funds. It is a critical factor that influences both the supply and demand for these funds. It represents the cost of borrowing and the return to saving. For savers, a higher interest rate means a better return on their savings. For borrowers, it means higher costs for loans. Like any other price, the interest rate adjusts to balance supply and demand in the loanable funds market. When the market is in equilibrium, the amount of funds savers want to lend equals the amount borrowers want to borrow. When saving is high, the supply of loanable funds is abundant and interest rates tend to be low. This encourages more borrowing and investment, which can stimulate economic growth. Conversely, when investment demand is strong, interest rates rise. Higher interest rates can attract more savings but may also discourage borrowing. This delicate balance ensures that the loanable funds market operates efficiently, matching savers with borrowers in a way that supports overall economic stability and growth. Section 10. Government deficits and their ripple effects. Government budget deficits can have significant economic consequences. When the government runs a deficit, it reduces national saving. This is because the government must borrow money to finance its spending. This borrowing reduces the supply of loanable funds available for private investment. Reduced investment can lead to slower economic growth. This is because businesses have less money to invest in capital goods. This can, in turn, lead to lower productivity and slower GDP growth. Government deficits can also lead to higher interest rates. This can make it more expensive for businesses and households to borrow money.